In this lesson, I'm going to show you a simple 10-step process for getting started with income property investing. These steps come from real transactions and what I've seen work again and again. The process begins by understanding the financial side of the deal. Then we follow the steps that move you toward ownership. Let's take a look at the 10-step roadmap. When people first look at income property, they often think it requires perfect timing or some kind of special insider knowledge. But in reality, most experienced investors simply follow a consistent process. They evaluate opportunities, check the numbers, and move forward when the deal makes sense. These 10 steps outline that process. So why am I sharing these 10 steps? Over the years, I've been involved in more than 100 income property deals. And along the way, you start to see patterns. You see what works and you see what doesn't. These 10 steps come out of that experience. It's simply a process that can help you get started. Let's begin with step 1, the calculator. The first step is to start with a calculator. Before you ever look at properties, you want to understand how the numbers work. The follow along calculator lets you practice analyzing deals in a simple way. You can enter rents, expenses, and loan terms and see what the deal looks like. When you understand the numbers, you're in the strongest position in the transaction, and that's why we start here. Next, you'll work with a lender to prepare your financing package. You introduce yourself and discuss your investment plans and down payment. The lender reviews your finances and estimates how much you can finance. Then they assemble a financing package that can be presented to banks that are making income property loans. And when you're ready to make an offer, you want a lender prepared to provide a letter of intent to submit with your offer. Now let's look at what the bank wants to see. When lenders evaluate a deal, they're really focused on the property. The key question is whether the income from the property supports the loan payment. They look at the rental income, the expenses, and the cash flow. From that, they calculate a debt coverage ratio. A common guideline is about a 1.2 ratio, meaning the property produces about 20% more income than the loan payment. Once you understand your buying power, the next step is working with a realtor. A good realtor will begin sending you daily listings of potential properties. Seeing many listings help you understand pricing, neighborhoods, and the types of opportunities available. Over time, your realtor learns what you're looking for and can help you identify deals that will fit your strategy. This is what a typical income property listing looks like. You'll usually see the asking price, the current rents, and basic operating information. Many listings will also show gross income, net operating income, and sometimes the cap rate. These numbers give you a quick snapshot of the deal, but remember, the listing is only a starting point. You still need to verify the numbers yourself. Once a property catches your attention, the next step is to check comparable properties. Comparable properties help you see how the property fits into the local market. You compare the subject property with similar buildings nearby. By looking at price, rents, and overall condition, you begin to see where your deal sits within the market range. As you compare properties, you're really looking for one that stands out from the rest. Many investors focus on value opportunities. That usually means a property where rents are below the market level. Sometimes it's poor management, sometimes it's outdated units, but the key idea is rental upside. If rents can improve over time, that creates the value opportunity. Once you've identified a potential opportunity, the next step is to test the deal with a calculator. You enter the rents, the operating expenses, and the loan terms. From there, you can measure the key investment metrics, like the gross rent multiplier and the cap rate. Most importantly, you calculate the debt coverage ratio to see if the income supports the loan. After running the numbers, the next step is to verify the rent assumptions. You want to check similar properties in the same neighborhood. Look at rental websites and local listings to see what comparable units are actually renting for. Focus on properties with similar condition, location, and unit size. This helps confirm whether the higher rents you're assuming are realistic. Next, you estimate the improvement costs. After walking through the property, you need to understand what repairs or upgrades may be required. Some properties may need very little work, while others may require significant improvements. You also want to consider ongoing repair and maintenance, which is often around 5% of the income. After this point, you decide whether the repairs fit within your budget or whether you may need to request credits from the seller. At this point, investors have a choice. Some investors actively make improvements and raise rents. Others simply maintain the property and allow time and inflation to do the work. As rents and property values rise over time, inflation can gradually increase the value of the investment, so the strategy really depends on the investor. This example shows how apartment wealth is often created. Let's say rents increase by $200 per unit. That additional income raises the property's total revenue. Buyers often value apartment buildings using the gross rent multiplier. Banks usually look at the cap rate and the income to determine how much they will finance. As the income increases, the value of the property can increase as well. That higher value can create additional equity and sometimes even refinance proceeds. The next step is choosing your funding strategy. In other words, how you raise the down payment. Some investors start with owner-occupied financing. If you don't own property yet, you may want to see our video on buying a fourplex using the buddy system. Other investors partner with investors to combine capital, and some use equity from another property to fund the purchase. There are several ways to raise the funds. The key is choosing the approach that will work best for you. Once the funding is in place, the next question is how everyone will hold title to the property. There are several ways investors structure ownership so the depreciation passes through to them. I've used all three of the structures shown here. Early on, I often used tenants in common because everyone signed directly on the deed, and that helped build trust with the investors. The key idea is choosing a structure where the depreciation passes through to the investors. And on the next slide, you'll see why that benefit can be so powerful. This slide shows why depreciation matters. A property may produce positive cash flow, but when you apply the depreciation deduction, it can create a loss for tax purposes. That loss can offset the income from the property. Instead of paying taxes on that income, the investor keeps more of the cash. In this example, that tax benefit increases the investor's cash return by roughly 35%. Once the property works, the next step is to make an offer. Your realtor prepares the purchase agreement and begins the transaction. The offer usually includes protective contingencies that give you time to complete inspections and confirm the financing. There are also timelines for deposits, due diligence, and closing escrow. These steps help move the transaction forward while protecting you, the buyer. Once the offer is accepted, the transaction moves into escrow. This is the time to verify everything about the deal. You complete property inspections, confirm the rents, and review the financial information. At the same time, the lender works through the loan approval process. Escrow gives the buyer time to confirm that the property and the numbers are exactly what you expected. If everything checks out, you move forward toward closing escrow. And if you'd like to see the full details of this process, we cover that in our video on escrows. Once escrow closes, the transaction is complete. Ownership transfers and you receive the final closing documents and keys. At that point, most investors turn the property over to a management company to handle the day-to-day operations. Management fees are typically built into the budget, often around 6%. From there, the investment begins to operate. Buying your first income property is really a series of steps. Learn the numbers, study the properties, evaluate opportunities, and take the next step forward. If you follow this process, you now know enough to begin pursuing your first deal. And if you'd like to practice running the numbers, you can download the follow along calculator in the description below. Most importantly, enjoy the process and have fun building your investment future.